Not everybody fits the same little square box, but Dave thinks that you do. You're the little birdie that broke its wing with debt, and you got to get out of debt. So you go to Dave Ramsey, and he baby steps you out of debt. But then once you're out of debt, Dave says, no, 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 little birdie. You got to live the rest of your life in this little cage that I gave you because I mended your wing. Come on, wake up, folks. You're being fed a line. I got two birds for you, Mr. Dave Ramsey. Bird one and birdie two. Tweet, tweet, mother. So I came across this video with Dave Ramsey and a gentleman by the name of Jim calling in, talking about what he did for his son, which I thought was really honorable. He bought his son a whole life insurance policy to then teach his son the infinite banking concept, basically to teach his son how to be the bank. And I always love watching these because it just purely shows you Dave Ramsey's lack of knowledge about what the infinite banking concept is. But not just that, it shows his knowledge about whole life, but his lack of knowledge about the uses of how whole life actually works in application. And I really want to point out the things he's right about, and I also want to point out the things he's wrong about, and I want to then meet in the middle and show you why really what Dave's saying doesn't matter at all. It's just him trying to act smart and stick to his narrative of buy term, invest the difference is the only thing anyone should do because that's all there is and that's it. So let's dive into this.
You claimed infinite banking concept was a scam and actually got quite pissed off about it.
Got quite pissed off.
So I do not agree with that in certain points that you made in that video. And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Right there. The father, Jim, set up a policy for his son. Just like our parents did, our grandparents did. What an honorable thing. And Dave Ramsey's only thing he could muster up is, I'm sorry. What an arrogant piece of you-know-what, anyway.
Say that again?
I said, I'm sorry.
And then he's laughing.
Yeah, so am I sometimes. No.
Real quick, I just want to preface that the first part of this, Jim said, I saw you do a video saying the infinite banking concept, which is a process, folks, not a product, is a scam. I want you to really take note how fast Dave Ramsey just goes right to the product, to the whole life. That's the key thing. The guy calls in about the infinite banking concept, and Dave Ramsey only wants to talk about product, 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 because that's all Dave Ramsey knows. He has no clue what the infinite banking concept is or how the process works, and I've proved that, and I'll prove it even more today.
So I set that policy up for him when he was 1 year old. It has a $500,000 face value. We pay $5,373 a year for 13 years.
So first off, I mean, Jim set a policy up for his son, and a couple of the things I noticed that you might not is, you know, when he's describing this policy that he set up for his son, he says, I set up a whole life policy. It's going to be funded for 13 years, so it's a limited pay, and it had a set death benefit of $500,000. So to me, knowing what we do, that means that Jim set up a normal whole life. It's not a specially designed whole life like we designed, but the key thing is I want you to understand this is just a normal whole life. Nothing like the ones we set up or the ones I set up for my daughter, Vivi. But yet it still performs really well, which you'll hear about in a second. So I want you to just keen in on that. Even though we're supposed to be talking about the process, all we're going to talk about is the product because Dave Ramsey has to be right. And we'll get into that.
There's a few points that I wanted to discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you, and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value. Dividend reinvestment is because you have a mutual company, and the policyholders are the owners of the company.
So here, Dave Ramsey's right. So Dave Ramsey's talking face value product stuff. He's not talking about the paid up additions rider. He's just talking the face value and the cash value. And I'm going to draw some things for you in a little bit, but I want you to understand that what Dave Ramsey's saying here is that the cash value dies when you die. He's basically referring to a basic off-the-shelf whole life with no paid-up additions. And then you'll hear Jim say the paid-up additions, and then Dave's quick response is dividend reinvestment is not cash value, which there, Dave Ramsey is wrong. Because when you take your dividends, which are paid out annually from a mutually owned insurance company only, not in a prior video, I gotta point out another thing Dave did. Dave doesn't even know which insurance companies are mutually owned and which ones are publicly traded, because he made mention to a publicly traded insurance company in the Infinite Banking video. But again, sorry to diverge, but he's talking about a mutually owned insurance company that pays dividends, and he's talking about the dividends being reinvested into a special rider called a paid up additions rider. I'm going to try to narrate this so that you understand what I'm talking about. Paid up additions rider is the sole thing Dave goes to and hones in on. So listen.
And so the profits from the company come to the policyholder, and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
So he's absolutely correct there. So in a mutually owned company, the policyholders are the owners, technically the owners. Therefore, when the insurance company shows profits at the end of the year, they declare a dividend. That dividend is then paid back to the policy holders. Now, the insurance company calls it a return of unused premiums, because that's essentially what profits are. Dave poo-pooed on that, saying, oh, it's just a return of unused premiums. Yeah, Dave, that's why the dividends in mutually owned insurance companies are tax-free, buddy. Not a bad thing and not a bad way to do it. But now he's saying that's not the same as keeping your cash value. But although Dave's right in technicality, he's wrong in application, and I will prove it in just a moment.
But it still works out to be having a cash value much greater than the $69,849 we put into it.
So this is key. Jim says, Dave's saying, no, it's not. It's not the same as cash value. And Jim says, but it still works out to having more cash value. So now, just think of it this way, right? You get your kid a specially designed whole life, or just a regular whole life policy. And it has a death benefit, and the illustration shows a cash value. In the cash value, you can look at two different columns, the guaranteed column, which is no dividend, and the non-guaranteed column, which is guaranteed interest plus dividends, because dividends are not guaranteed. But the insurance companies, every single one of the mutuals, have paid dividends every single year consecutively. And the ones we use, which are the top 5, they've never missed a dividend, and they've paid them out well over 140 years. So that's the column you look at. And when you look at that column, what you will see is you'll see dividend declared, so that year's dividend. You'll see it going into paid up additions, and then you'll see one column on the illustration for cash value, not two. One column for cash value. And when the dividend comes out, the cash value goes up by the amount of the dividend. Okay, that's pretty simple. But you know what else goes up? The death benefit, which is exactly what this whole argument is going to turn out to be, is that dividends and the growth of cash value does not go to the death benefit. So when the dividend buys paid up additions every year, it increases the cash value and also increases the death benefit. Now, just give me one moment, and I'm going to draw that for you in literally 5th grade, as simple as I can get, so my daughter could understand this. But let's just let him finish his little rant here.
Actual cash value, not the paid up additions. The actual cash value dies with you.
No, because
yes, it does.
Okay, but
he said the actual cash value is not the paid up additions. Now, he's right in saying that. He said the actual cash value dies with you. Technically, yes, but not in theory, not in application.
But your death benefit is larger than your cash value. So for me, I looked at it
because you bought more insurance. You know what a paid up addition is? A paid up addition is buying additional insurance. That's why you're getting more at death. Not because you got your cash value, but because you used your policy dividends to buy additional insurance.
Right, but
that's different than getting your cash value.
So I got to point out this. It's interesting how Dave Ramsey uses his show to drive home just his narrative, just his point. And anyone that calls in to kind of just challenge it, he basically uses his platform, he uses his control to completely suppress the other person's objectives. And it's also pretty funny how Dave Ramsey has one way that everybody should do things, right? Buy term, invest the difference. Eat beans and rice and then rice and beans. It's not mix the rice and beans and the beans and rice with a nice ice cream cone because you've been a good boy. No. It's just stick to his narrative. And the other thing too that you might not know, Dave Ramsey also has the company that sells the term insurance. Another fun fact for all of you to know this is term insurance is the most profitable life insurance that insurance companies sell. Do you know why? Well, you're probably thinking, well, how can it be the most profitable? It's the cheapest. Cost is only an issue in the absence of value. You see, the term insurance policies are for a term of time, 10 years, 20 years, 30 years. And because it's for 10, 20, 30 years, the actuaries at the life insurance companies know when you're going to die. They know when I'm going to die. They know when Dave's going to die within a very accurate percentage. So because they know when we're going to die, when you get underwritten for a term policy for 20 years, they know that you're not going to die in 20 years. They know that because of actuarial tables, and they are so accurate that less than 2% of all term policies are ever paid out on. So if you're an insurance company and you sell a term policy, you know you got a 98+% chance of never having to pay that death benefit. So talk about profits. It doesn't matter how cheap the premiums are, you're still, as the insurance company, profiting the most because 98% of that profit you keep. You only pay out on less than 2%. That's what I'm trying to talk about. Not everybody fits the same little square box, but Dave thinks that you do. You're the little birdie that broke its wing with debt, and you got to get out of debt. So you go to Dave Ramsey, and he baby steps you out of debt. But then once you're out of debt, Dave says, no, little birdie. You got to live the rest of your life in this little cage that I gave you because I mended your wing. You can't fly free. You can't explore other options. Oh, no. You got to stay in my little cage. Oh, and I'll feed you. I'll feed you term insurance. And then not only term, I'll let you buy mutual funds just from my certified financial advisors. Oh, and little birdie, they pay me a fee every single month just so you get the best financial advisors and best advice. Come on, wake up, folks. It's bullshit. You're being fed a line. I got two birds for you, Mr. Dave Ramsey. Bird 1 and birdie 2. Tweet. So I'm going to show this to you in the simplest way I know possible. I've been doing this over 20 years, but I remember back to 2003 when I was first explained how paid up additions work. And it's quite simple. So first, I'm just going to draw what a regular whole life insurance policy is. There's really two components. Number one, there's a death benefit, okay, which we all know. This is called face value. So I'm just going to write face value, because that's how Dave talks about it. He says the face value. Face value is death benefit. And number two, in a whole life, part of the premium deposit goes into the cash value. Cash value is the liquid money that you have to use. So it's cashola that you can use anytime or you can take loans from, right? So that's it. That's a whole life. And then all you do is you're putting a premium into that whole life each year. That premium's buying a death benefit, a face value, and you're getting cash value out of it, right? That's how Dave Ramsey would understand whole life. Now, paid up additions, they talk about that a lot in this video. And I want to be clear, paid up additions are what we use when we specially design these whole lives to be used for the infinite banking concept so that you can become the bank. It's very important. It's a key element to designing the whole life for maximum cash value, which is what Jim was talking about for his son, right? Cash value for his son. And yes, they were talking death benefit, but Dave Ramsey went right into the product specific, saying the cash value dies with you and it doesn't go up by, or the death benefit doesn't go up by the cash value. A roundabout way. So let me show you paid up additions. So every single year, a dividend is declared, and that dividend is paid out in cash. And Jim or any policy owner can apply that dividend anywhere. They could take that dividend in a check every single time it's declared. But what most of them will do is buy paid up additions. And just like it sounds, and just like Dave described, paid up additions, you're buying paid up additional insurance. Great. So since we already understand what the insurance is, it's a death benefit and a cash value, when the dividend is declared and we put it to paid up additions, I want you to think of it like this. All we're doing is we're buying a little whole life. And every one of these little whole lives has a death benefit and cash value. And every single year, we just keep buying a little paid up addition policy, which also has death benefit and cash value. So every single year, the more we put into the paid up additions, if it's just the dividend, great. If it's part of the premium, remember we design these anywhere between 60 to 90% of the premium deposit goes to the paid up additions. So as you can see, we can escalate this. So Dave Ramsey goes on to say that the cash value dies with you. But then Jim says, but I'm going to paid up additions and the death benefit and the cash value are increasing. See, all Jim sees is death benefit and cash value on his policy. He doesn't see death benefit and cash value of policy 1 and paid up addition 1. It's all combined. It's all one component. So as more paid up additions are added and more dividends are paid, you are increasing the cash value significantly. But while you increase the cash value, you're also increasing the death benefit. So if Jim's child were to die, the death benefit that's paid out is not just the face value, as Mr. Dave Ramsey's saying. It is the face value plus all the additional paid up addition death benefits. Now, some of you might be like, that's what Dave's saying, but yeah, but at the end of the day, what is it that you want? You want the most cash value to use, and you want the most death benefit when you die for your family, right? So what is all this malarkey Dave's talking about?
Oh, you don't get the cash value and the death benefit are not attached.
Okay, let's get back into the video because now shit's gonna get real and Dave is really gonna put his foot in his mouth, or at least that's how I see it. I'd really like to ask your favor on something. Matter of fact, see that little button right there? It says subscribe. Please click that. And also there's a little bell up top. What? Smash that bell.
If you took those policy dividends and went and bought a term insurance policy for $100,000, well, you'd get $100,000, but that's not your cash value.
Well, I have a term policy.
I know, but you missed my point. Okay, you're talking about you use the policy dividends, you use the money they send to you because you're in a mutual company to buy additional insurance.
Yes, paid up additions,
Yeah. If you buy a term policy on the side for $100,000 instead with that same money, you would get $100,000 more than your face value, but that's not your cash value. That's additional insurance. They're different.
Right, they are different.
So he's just explaining the difference between term and paid up additions, which is all good and fine, but also inside the whole life, the way we build them, we almost always add a term rider. But Dave has never called me up and said, hey, Chris, you're doing such a great job. Keep adding those term riders to those specially designed whole life policies. Oh, no.
In term, you don't have cash value to borrow against.
I'm aware of that, but your point was that you don't lose the cash value, and my point is 100% of the time, by definition, you lose the cash value.
Okay, so as I said, tit for tat.
So Jim says tit for tat, and I think that's a really good thing right there that he said. I think it startles Dave because it is. It's kind of tit for tat because it is tit for tat. Dave's trying to drive home his point, which is completely pointless and really holds no water at all. It doesn't change anything. He's just trying to be right because of his arrogance. He just can't ever admit, all right, you're right. Maybe that was the right thing for you to do for your son. He just can't admit that because he's too egotistical and too just caught up in his own little world.
To be 80. I'm looking at the readout here.
He's saying if his son lives to 80.
He only lives to be 80.
Okay. All right.
The cash value will be worth about $2 million, but the payout for the death benefit will be $2.6 million. So, okay, technically, yes.
So you take the cash you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about.
So what Dave's saying, if you took your dividends and instead of buying paid up additions, if you bought term policies, you'd have more life insurance. Dave is absolutely correct there. You'd have a lot more life insurance, a lot more useless life insurance. that, like I explained earlier, would never pay out because less than 2% of all term policies ever pay out. So Dave is, again, driving home a narrative of something that more than likely would never happen. He's just saying you'd get more life insurance by buying term. He's absolutely correct. But does it matter how much more life insurance you have? Doesn't it matter how much life insurance pays out the day you die? Isn't that what we're all doing this for? Don't we want our families to have more money the day we die? Not, do we want to go to our families and say, hey, listen, I got lots of life insurance. It's all term insurance because Dave said buy term. But here's the bad news. I got to die next year in order for that term insurance to pay out. So let's think of some ideas here. Is that really the conversation you want to have? Because that is what Dave thinks the conversation should be. Or he just doesn't think.
You would have more than you're talking about because you get a better buy on the insurance than you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank. And
well,
I think that's
okay. But here's the thing:
the big thing
that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement.
I have no idea where that discussion came in. You're going to have more money at retirement. I don't remember Jim ever saying anything about retirement at all. Dave just interjects into the conversation retirement, like there was no discussion of that. The discussion was the infinite banking concept, meaning Dave has no understanding of what the infinite banking concept is. I've proven this time and time again with multiple Dave Ramsey videos. And here, yet again. And I'm sorry, just full transparency disclaimer, this is about the point in the video where I start to get really pissed off. Oh, you thought I was mad up to this point? Nah, I was just messing around. This is where I get really upset.
$5,000 a year for 13 years. Do you know what that would be in a mutual fund?
I don't know, Dave. Why don't you tell me what a mutual fund that would be?
At age 88? It would be $25 million, dude.
I just don't know where he comes up with $25 million, but...
Dude.
He's going to have that anyway.
No, instead of putting it into this rip-off thing and making 4% on your money, and when he dies, he loses his cash
4%.
value.
Don't know where that comes from.
If you put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite
and he's
freaking
making
bank.
false claims.
But we're only putting in $70,000.
So there you go. He's putting in $70,000 total.
Present value formula
and then Dave
works
Ramsey goes to this present value calculator.
Look, let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second, okay? Take the same amount of money when you get off the air and put it in a financial calculator at 11% and pretend it was invested in mutual funds and see what it is when he's 88 years old.
It'll be more.
A whole lot more.
And he'll have that too. With this, to me,
I can't disagree with Dave here. If you took the $5,000, put it into investments, and you just left the money there from whatever age the kid is all the way till age 80 or 88 that they're doing, it would have more money than the specially designed whole life would. But Dave, again, doesn't understand the infinite banking concept. So in a second, I'll show you how you could do exactly what Dave's telling him to do. Take money and put it into investments in a mutual fund, and it would be worth a lot more in that amount of time. That's if the kid never takes the money out of the mutual funds. That's if the kid doesn't need it to buy a car or a house or anything else. He's just got to leave it sit in those mutual funds until whenever, Dave Ramsey tells him to, because remember, he's locked in that little cage. But here's the thing. Now, just imagine this. Where did the money come from to invest in those mutual funds in Dave's little mind? Came from a bank account, right? Or maybe the envelope Dave always does, the cash in the envelope. But the money came from somewhere. So all we're talking about with the infinite banking concept is changing where the money starts. It starts in a specially designed whole life. Then we take the money out of the whole life, and we could invest it in mutual funds if that's what the client, or in this case, the kid wanted to invest in. But we never stop earning interest and dividends inside the specially designed whole life. It's uninterrupted. So we make interest and dividends for that entire period of time on the whole life and all the money. And then we make money in the mutual funds. And the only differential in the middle is the interest the insurance company charges you, which is nominal because you're already earning more than that inside the whole life. You get to make money twice on the same dollar. You get to make money and spend money at the same time. If you do Dave's model, buy term, invest the difference, you can't do that. You're buying term, so you better die. You better die, little boy, in that time that your term goes till. Otherwise, you're not going to have any life insurance at all because the insurance company is going to win. But then you're going to have all this money in this mutual fund. God forbid that the market's down when you want to take it out. You're not going to want to do that. God forbid you don't pay your taxes or you're going to have a huge tax hit. You make $25 million and all of its gain, yeah, that's a big tax hit. Inside the whole life, the money grew tax-free. But at the end of the day, I'm trying to tell you is you can have both. This is not a case where Jim or Jim's kid has to decide, oh, should I buy term and invest the difference, or should I do the whole life? Or should I buy the whole life and invest in Dave Ramsey's magic mutual fund? No, it's buy the whole life and the investments with the same dollar. You see what I'm saying? The money just goes into the whole life, comes out of the whole life, and invest whatever you want to do with it. Buy cars, do anything you want in your life. You can do both with the infinite banking concept, but Dave doesn't understand the infinite banking concept. But yet, in the beginning, Jim said, infinite banking. Now let's just get through the end of this because now I'm getting fired up and I'm going to try to hold my composure. I'm going to put my glasses on so I stay calm.
That's called opportunity cost on your money. You put it into something that's going to make him at 88 have $2.5 million, and he should have had $25 million.
Again, Dave's debating $2.5 million and $25 million and acting like one or the other. You got to pick one or the other. You can have both.
Because you screwed up and put it in the wrong thing.
Well, when we screwed up and put it in real estate too, and he's going to get real estate.
Well, then put the money in real estate.
And then he goes, real estate. Same thing. Put the money in real estate then, Dave says. Well, this Jim guy doesn't, see, Dave's controlling the narrative because it's Dave's show. I get it. But Jim could take the money, put it into the whole life for the kid, and then take the money out of the whole life and buy real estate and get the same thing, but still have all of the money growing, still have the death benefit for the rest of his life. Folks, listen, as I keep saying this, if you want to learn more about this, then definitely get a hold of us. Put a comment below, and then we will call you and walk you through why Dave is wrong. I know everybody wants to believe Dave. That's fine. Believe Dave. But let me prove to you that Dave Ramsey's not right, and I can prove it mathematically. Put a comment below. I don't care if it's good, bad, or not. You can hate on me all you want, because all my haters, you need hugs too.
Hey, if you've got $25 million in mutual funds, you can borrow against it.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him
you guys
that
see Dave kind of pick his nose?
Borrowing against money that his father invested for him. That's how he builds wealth. Said no one rich ever.
I mean, banks use this product to.
No, they do not. You've been watching too much TikTok. Banks do not use whole life. Not ever. Banks nowhere, no banks sell.
Dave just said banks do not use whole life, ever. So technically, Dave's right, because banks buy BOLI, bank-owned life insurance. But bank-owned life insurance is the exact same thing as whole life, just different tax structures because it's banks. Look it up. Go to Google and type in BOLI, B-O-L-I, and then compare that to a whole life, where Dave Ramsey's saying, no, they don't, no, they don't.
They do not use whole life insurance.
What bank?
Well, we Google it and see what typically banks do with their money, but I believe
typically banks never put money. Let me tell you what banks do. They put it in bonds. They're required to.
Holy crap! Dave is literally putting his foot in his mouth. Dave is literally saying that banks don't buy life insurance. Folks, go to FDIC.gov. That is a federal website. Type in BOLI. Give me the definition. Hell, I'll give it to you right now. See? There it is, the definition of BOLI. And Dave just said banks don't buy life insurance with their Tier 1 capital. They only buy bonds. That right there should be all I need to tell you. If you're listening to somebody that convincingly and he's so stuck in his own head saying that they don't buy life insurance, it's insane.
It's not a place to invest money because it's a horrible investment.
Dave's right. Whole life insurance is not an investment because it's guaranteed. Dave wants you to invest money, which has risk. Do you want a bunch of risk with Dave Ramsey, or do you want guarantees with the whole life? Whole life is not an investment. So again, Dave's right. You don't invest in whole life. You use whole life as a savings vehicle, a place to park your capital.
The rate of return
4%.
sucks.
The rate of return sucks compared to what? Compared to what? I'm sorry, Dave, the rate of return sucks compared to what? Compares to your bank account? Because your bank account's probably paying you 0 to, I don't know, what is it paying you, Dave? What's your bank accounts at your special bank paying you? They're guaranteed returns. So if a whole life policy pays you a guaranteed 3.25%, that doesn't include the dividend, just the guaranteed interest. Is that a good guaranteed interest rate if it's tax-free? Some of you would say yes, some of you would say no. Then tell me, where can you get a guaranteed tax-free rate of return for 3.25% every single year? It can never change. If the Fed drops rates, the whole life insurance contract will guarantee you the same interest rate for the rest of your life. Where else can you get that? So Dave Ramsey, where's your basis? What are you saying the rate of return sucks to compared to what? Compared to a bank account, a money market, a CD? All of those returns are not relevant because they all can change. This guaranteed interest rate does not change. This guaranteed interest rate is tax-free if built properly. So this is what I'm talking about with Dave Ramsey. He just keeps burying himself further and further.
And when you die, you lose your cash value.
And when you die, you lose your cash value. Refer back to the drawing.
I know, but you also, you're making it sound like I'm losing money on the whole.
You
thing.
are. You're leaving money on the table.
You're making it sound like when, not me, but my son, when he dies, that he's only going to be able to get his.
He's going to have $22 million less than he should have.
$22 million less than he should have. Dave isn't factoring in estate taxes, federal estate taxes or state estate taxes, because at $25 million, you got an estate tax problem. Call any attorney. You're going to be giving the federal government roughly 40% of your money because of estate taxes. Dave's not talking about that. Oh no. Dave's not talking about all the taxes you would have to pay on all that gain over that many years. Dave's not talking about any of that stuff. Not talking about the fees from the mutual funds either.
If you had put this in a good investment.
Well, you had mentioned that the cash value dies and you only get the face value. That's
Correct.
Not true.
That is true.
That's not.
I just covered that with you for the last 10 minutes. Paid up additions are the only way that cash value increases unless you're using a universal life program B where you pay extra to get the extra insurance, which is another form of paid up additions.
That isn't coming out of my pocket though. I put $70,000.
It is coming out of your pocket.
It's coming out of the policy's pocket.
I know. The policy, you put the money in, dude. And then it paid you a dividend, and you chose to buy more of this crap with the dividend, and you're calling that I kept my cash value. No, you didn't. You bought more insurance.
Well, I know that I put in $70,000, and at a certain age, it's going to be at age... When he's 15 years old, that's going to be paid up.
Yeah, Jim, you understand what paid up is? You understand if you're alive that there's a probability of your death. And so 100% of the time that a life insurance program is paid up, it means that you prepaid it. That's all it means. Because as long as there's a probability of death, there's a cost. So the insurance company has always got a cost as long as you're alive. So there is no such thing as a paid up. That's an industry term that gets suckers like you. That's what it is. No, paid up means prepaid. You paid all of the premiums in 13 years for his whole freaking life in advance. That's why it's paid up. Hey, man, I think you ought to keep it. It's perfect for you. But thanks for the call.
I don't even know how all of you could watch that video and literally think Dave makes a good point there. I mean, after I just went through and drew things out and explained it, like Jim was right, but Dave came in with technicalities that mean absolutely nothing. Because let me ask you all a question. And I'm going to slow this down because I'm from New York, I talk fast. So let's do this super slow. When you are looking to buy a life insurance policy, what are the reasons you buy it? Number one, to protect your family in the event of you dying too soon. Define too soon. To me, too soon is any time before God tells me it's my time. And I'd like to live into my 90s, maybe even a little bit more. Like, I don't want to have to time my death like I would with term. So you're buying a life insurance death benefit to be paid out whenever you die on your terms. Secondarily, when you buy a permanent life insurance policy, you want to make sure that that death benefit will pay out for your entire life, unlike term insurance, which pays out for a term of time. Understand that? Term insurance is like renting your insurance for 5, 10, 20, 30 years, however long of a term you buy. You're renting it. You have no equity. Buying a whole life or any other permanent life insurance, you're building equity over time. Cash value. So when you're buying a whole life, you're getting a death benefit for your whole life, and cash value, which grows at a guaranteed interest rate, plus if it's a mutually owned company, pays you dividends every single year, which if you take the dividends and do what they're doing, put them in paid up additions, then those paid up additions increase your death benefit and also increase your cash value, contrary to what Dave is trying to say, which made no sense. Some of you actually probably got stupider by watching Dave Ramsey's video. But as you put money in paid up additions, you get more cash value, of which you can use the cash value anytime for anything, anywhere, and you get more death benefit so that someday when you die on your terms, your family gets more money. We understand that, right? That's just the product. Add the infinite banking concept and you completely change the dynamic of your entire financial future. The policy, whole life term, that doesn't solve the problem. It just escalates it. It just makes it more efficient for you to solve the problem. The infinite banking concept, which Dave completely skipped over, didn't even want to talk about it because he doesn't understand it, is what makes the difference. The policy just makes your money work for you more efficiently. If you want to learn more about the infinite banking concept and you want the truth about how the machine, a specially designed whole life, actually makes you more money over time, not because you work harder, longer, or take on more risk. No, no, no. Because of mathematics, because of compounding interest. You want to learn about that? Put a comment below or send me a message. Send me a DM and I will get back to you, or someone on my team will get back to you, and we will walk through your situation and we will mathematically solve your problem. And if we can't, guess what? There's always Dave Ramsey. Hey, if you liked this video, check this one out right here called Max Cash Value. See you on the next one.